Hey, welcome back to MarketSnap. It's July 2026, and honestly, there is a lot to sort through right now. Earnings season is heating up, AI spending is still dominating the conversation, rates have been choppy, and investors are trying to figure out whether the next move is more AI upside or a rotation into cheaper names. So I pulled together 5 stocks to check this month. Not 5 stocks to buy. Not 5 magic tickets to financial freedom, because unfortunately, this is investing, not a vending machine. These are 5 names where the MarketSnap model, the fundamentals, and the current market narrative all create an interesting setup. We have one software name with a big valuation gap, one mega-cap cash machine where the AI capex debate is the whole story, 2 AI infrastructure names with very different risk profiles, and one beaten-down packaged food company with earnings coming up this month. I'm not going to spoil the list. Let's go through them one by one. Stock number 1, Salesforce Inc., ticker CRM. So let's talk about Salesforce. Yeah, the giant in customer relationship management software, ticker CRM. And honestly, this one caught my eye because of the gap between where it's trading and what our model thinks it could be worth down the road. Let me break that down. Picture this. Today's shares are sitting around $170. Our MarketSnap fair value estimate over 5 years? Roughly $390. That's a pretty big spread. Our model projects a base CAGR of roughly 19% over that time frame. So if you put in $10,000 today, the 5-year ending value could be around $24,000. Now, I should be clear. These are model estimates, and assumptions change outcomes a lot. That same $170 today could be worth a lot more or a lot less depending on growth rates and discount rates. But the gap is hard to ignore. Here's what jumped out at me about the fundamentals. Revenue for the most recent fiscal year came in at around $41.5 billion. That's up about 9.5% from the prior year. Not explosive growth, but steady. What I really like is the free cash flow. That was around $14.4 billion in the latest year. That's a massive cash machine. The company is generating about 35% of its revenue in free cash flow. That's impressive for any software business. The weird part is the stock has been hammered, down about 35% over 6 months, down nearly 39% over the past year. Some of that is concern about disruption. The fear is that AI tools might eat into Salesforce's core business. But here's the thing I had to look twice at. Analysts still expect earnings to grow. Salesforce just announced the U.S. Air Force is using its Mission Force platform to manage an 84,000-vehicle, $13.5 billion fleet across hundreds of locations. That is the kind of large, sticky government workflow win that pushes back on the narrative that AI instantly makes traditional CRM obsolete. Estimates for fiscal 2027 show EPS around $14, up from about $11.80 in the current year. And by fiscal 2029, estimates are pushing toward $18 per share. So the catch? The elephant in the room is AI disruption risk. There's a real debate about whether tools like chatbots and AI agents reduce the need for traditional CRM software. Salesforce itself is racing into AI with products like Agentforce. But if AI actually shrinks the market, the growth assumptions behind that $390 fair value get shaky. Also, the stock is still trading at around 18 times earnings. That's cheap for Salesforce historically, but maybe deserved if growth slows. My take, I think the market is pricing in a very negative scenario that probably doesn't fully play out. Salesforce generates absurd amounts of free cash flow. They have a massive installed base. They are investing in AI themselves. If they can sustain even mid-single-digit revenue growth and keep margins healthy, that $390 fair value starts to look plausible. But you need to believe AI won't gut their business model. I'm leaning toward the gap being real, not a value trap. Keep Salesforce Inc. on your watch list and watch the AI narrative closely. That is the swing factor. Stock number 2, Meta Platforms Inc., ticker META. So Meta Platforms, you probably know the story. Facebook, Instagram, WhatsApp, all under one roof. But here's what jumped out at me. This is a cash machine that has been reinvesting aggressively into AI and long-term infrastructure, and the market has become more skeptical around that spending. Let's talk about why that might be a disconnect. Picture this on valuation. Today, the stock is around $580. Our model at MarketSnap puts the 5-year fair value at roughly $600. That's almost exactly where it trades now. Not exciting on the surface. But here's the thing. Those numbers shift a lot if assumptions change. A different growth rate, discount rate, or margin assumption could swing fair value way up or down. Now let's get into the fundamentals, because that's where Meta gets interesting. Last fiscal year, revenue hit around $201 billion. That's up 22% from the year before. Operating margin, over 41%. I had to look twice at that. Net profit margin is around 33%. And return on equity, 33% as well. Those are elite numbers for a company this size. Free cash flow last year was about $46 billion. That's after huge capital spending, mostly tied to AI infrastructure. So the core business is incredibly profitable. Bloomberg reported that Meta is building out something internally called Meta Compute, basically a plan to sell access to its AI models and, eventually, spare GPU capacity to outside customers. Zuckerberg had already said on the May call that monetizing unused compute is on the table. The market treated that as a real pivot, not just capex with no payoff. Then this week, Meta said it will invest more than $9 billion in its first AI data center in Canada, a 1-gigawatt AI-optimized site in Alberta, its largest footprint outside the US. So the story is shifting from pure spend to maybe a release valve. If Meta can rent out even a slice of that infrastructure, Wall Street gets a path to justify the build-out. The catch is, we still do not know how much external revenue that generates. And earnings on July 29th are when management will probably have to put numbers around it. My take, Meta is a quality compounder trading at a fair price. Not cheap, not expensive. The financial profile is best in class. 33% net margins, 33% ROE, 22% revenue growth. But the size of the capex bet makes this a high-conviction hold, not a slam dunk. If AI monetization accelerates, these numbers could look conservative. If it stalls, the stock could stay range-bound for years. I think the ad business still supports a lot of this valuation, but AI is not a free option. Though if Meta Compute works, some of that capex could start looking more like infrastructure with a revenue stream, not just a bill. Keep Meta Platforms Inc. on your watch list. This is a name to watch closely when the capex anxiety starts to fade or when the market gets proof that the spending is actually working. Stock number 3, Broadcom Inc., ticker AVGO. This one is a quality compounder, and honestly, it has been through the ringer lately. The stock has sold off sharply, and for a company this size, that kind of move always gets my attention. But here's why it's on our list this month. When a high-quality business gets sold off hard, it can create an interesting setup for patient investors. Let's talk valuation, because that's really the story here. Today, shares are trading around $360. Our MarketSnap fair value estimate over the next 5 years is roughly $580. That implies a base CAGR of about 10%. So if you put $10,000 into Broadcom today, our model suggests it could be worth around $16,000 in 5 years. Big caveat though, assumptions change, and those numbers can swing a lot. This is not a precise target. It is a ballpark estimate based on current data. Here's what jumped out at me from the fundamentals. Revenue hit nearly $64 billion in the last fiscal year, up almost 24% from the year before. And get this, operating margins were around 44%. That is incredibly high for a semiconductor company. Free cash flow was $27 billion. That's a lot of cash being thrown off. Return on equity came in around 36%. So you're looking at a business that prints money, has wide margins, and generates strong returns on the capital it invests. But there's a catch. The stock got hit despite strong numbers because investors are starting to question how long this AI infrastructure boom can keep going. Some analysts are worried about AI infrastructure spending peaking, and there has been a lot of noise comparing this build-out to the dot-com telecom boom. Valuation is still demanding. The trailing multiple is elevated, and even on forward numbers, Broadcom is not exactly sitting in the bargain bin. So if AI demand slows, the multiple could compress hard. My take, Broadcom is the kind of business you want to own over a full market cycle, but the price trajectory matters a ton. At around $360, the sell-off has brought valuation closer to reason, but it is still not cheap by traditional standards. The thing that could break the compounder thesis here is if AI infrastructure spending turns out to be a bubble. If that happens, Broadcom's revenue growth could slow sharply and the stock could fall further. But if AI is the real long-term trend, and I think it is, then this pullback could look smart in hindsight. I would not chase it blindly here, but I would keep it high on my radar for any further weakness. Keep Broadcom Inc. on your watch list. Stock number 4, Micron Technology Inc., ticker MU. This is one of those names that keeps showing up in our quality compounder screen, and honestly, I get why. The business has been on an absolute tear. But here's the thing, you've probably seen the headlines. Michael Burry, the guy from The Big Short, reportedly disclosed a short position on MU. That got my attention. So let's dig into what's actually going on here. On valuation, here's where our model lands. Today, the stock is trading at around $980. Our MarketSnap 5-year fair value estimate comes in at roughly $1,800. That implies a base CAGR of about 13% over the next 5 years. And if you put $10,000 in today, our model suggests it could grow to around $19,000 by 2031. Big caveat, though. These are model estimates. Assumptions change a lot, so take that with a grain of salt. Now, the fundamentals are where this gets interesting. Revenue last fiscal year was around $37 billion, up almost 49% from the year before. Net income, over $8.5 billion. That is a massive swing from just a couple years ago when they were losing money. The return on equity is sitting near 71%, and return on invested capital is around 44%. Those are elite numbers for any company, let alone a semiconductor firm. Free cash flow came in at over $17 billion last year. The balance sheet is clean too. Debt to equity is only about 6%, and the current ratio is over 3.4, meaning they have plenty of liquidity. Micron just reported a blowout quarter, revenue up sharply, margins in the 80% range, and guidance raised on surging memory prices tied to AI demand. The odd part is the stock still sold off more than 10% afterward and is in a technical bear market off the highs, partly because investors are debating whether the memory supercycle is peaking. The catch? Micron is cyclical. Memory chips go through boom and bust cycles. Right now, we are in a boom driven by a demand for high bandwidth memory, or HBM, but peak margins could mean we are near the top of the cycle. Samsung also flagged a massive profit jump in memory, which adds competition, and Citi flagged Chinese memory makers gaining traction as a longer-term margin risk. The stock is still up roughly 700% over the past year in our performance data, even after this pullback, which is exactly the kind of number that makes people excited and nervous at the same time. So the Burry short and the post-earnings drop are happening after an enormous run, not from a quiet base. My take, Micron is exactly the kind of compounder we look for when the numbers line up. The return on capital, revenue growth, and free cash flow generation are best in class. But the cyclical risk is real, and after a move like this, the market is already pricing in a lot of future growth. I think the AI memory story has legs, but I would not be surprised to see volatility ahead. The model says there is still upside over 5 years, but the path could be bumpy. Stock number 5, the Simply Good Foods Company, ticker SMPL. You might know the brands, Atkins bars, Quest protein chips, and even a new dill pickle flavor that just dropped. This is a packaged food company that lives in the protein snack aisle, and honestly, it has been through a lot lately. The stock got cut in half over the past year. We're talking down roughly 57% in 12 months. But here's the thing. Earnings are coming on July 9th, and that is why it is on our list this month. So on valuation, let me walk you through what our model sees. Today, the stock is around $14. MarketSnap fair value over the next 5 years? Roughly $17. That gap is not huge, maybe 20%. Our base CAGR estimate is roughly 5%. So if you put in $10,000 today, our model says it could be worth around $13,000 in 5 years. Ballpark. And of course, assumptions change. Different growth or discount inputs could swing that number a lot either way. Now let's talk about that earnings catalyst. Wall Street is looking for roughly 35 to 36 cents per share on revenue of about $333 million. The whisper number matters here because this company has had some serious headwinds. Revenue was about $1.45 billion last fiscal year. That's up 9% from the year before. Free cash flow came in at around $158 million. So the core business is generating cash, but there is a big ugly cloud hanging over the name. The catch, and I have to mention this, is the securities fraud investigation. Multiple law firms have announced probes after the stock dropped 18% in a single day back in May. The issue? Expansion problems that allegedly were not disclosed properly. So there is legal risk here. That is real. And it is probably one reason why the stock is sitting at a low forward multiple. Yes, it sounds cheap, but cheap does not always mean safe. Beautiful little rule of investing, and somehow people still keep learning it the expensive way. My take, Simply Good Foods is a classic show-me story right now. The brands have genuine consumer pull. Quest is still growing. Atkins is repositioning around GLP-1 drugs instead of fighting them. But with an active investigation and a stock that has been brutalized, the July 9th report needs to be clean. I want to see revenue beat estimates, hear something concrete about the expansion issues, and get a forward guide that does not spook anyone. If the numbers hold up, that $14 price starts looking interesting. If they don't, this could get uglier. Keep the Simply Good Foods company on your watch list for the earnings read on both the consumer and the legal side. That wraps up our 5 stocks to check for July 2026. Remember, nothing here is personal advice. This is just a watch list based on our model's work. Always do your own research before making any moves. If you want to dig deeper on any of these, the MarketSnap screener, the intrinsic value calculator, and the full investment outlook are all linked in the description below. Thanks for watching. I'll see you in the next video.